serious from around 2022. But what I mean by taking it serious is that I started picking up books. I mean books and taking time to watch a lot of videos from highly recognized investors that have beaten the market over time. I'm doing this as an hobby. I'm not really interested in maybe like trying to beat Nigerian markets, but I would like to get better at it because according to Warren Buffett, he said being a good investor makes you a better business owner because the better you get in investing, the better you know what they call capital allocation, how to get the best return on your capital. Because in the market, there are low returns and there are high returns. And there are some high returns with high risks that you lose your capital. And there are also some low returns with still high risks that you lose your capital. So it is better to know how fundamental investors, that means people who use fundamental data to value businesses. They are not trying to value a stock. They are using the stock to know what is the market pricing the business at the moment. They are not looking at the stock price. We are using the stock price to look at all the numbers of available stock and try to know what is the market capitalization of this business, and if somebody that is a private purchaser of that business, that means somebody that wants to buy the business, like maybe through a merger, a private buyer will buy that business if that business is not listed on the stock exchange. And if you look at in reference, you can look at maybe like Lafarge. Recently Lafarge has been bought by some Chinese companies. They have to pay the real market price, and Guinness too, they have to pay market price. They are not paying the stock price that is listed on the Nigerian Stock Exchange. They are looking at what is the real price a private buyer would buy. So when you are trying to buy a stock, maybe it goes up 50%, it goes up 20%. You are not really paying, you are just looking at the stock as you are speculating because you don't really know what the business does. You are not looking at the business like a owner, the ownership mindset, like this business is mine. If I'm going to be the one running this business or hiring a manager for this business, and I have all this capital employed inside this business, what kind of return am I expecting? Does this return beat inflation? Then some of the retained earning of this business, is it being deployed with the right return on invested capital, or is it better than that business manager should have paid you a dividend? There are some companies that are holding more earning. They are holding their earning because it's a capital intensive business. The business burn cash. They don't make free cash flow that they can redeploy as dividend. Some businesses are making good net earning, but they have to redeploy most of those earning into capex, that's capital expenditures. So if a business has to be redeploying most of its earning into capital expenditure, those kind of business, it will take time before you get return because you still have to depreciate those assets that has been what, that has been capitalized. You have to depreciate them. So over time you don't really get much dividend, or they have to refinance with loans, and you have to, the companies have to keep paying interest instead of dividend. But there are some businesses, for example, I will look at Okomo. Okomo has been one of the businesses I find the most interesting. It is just painful that Okomo cannot reinvest capital at the return on invested capital it can get. As in, Okomo has the problem that they generate a lot of cash, but they can't redeploy it in the business. And their return on invested capital is very high, but they can't redeploy it. So they have to pay us dividend, almost 80% of earning is paid as dividend. And even if you check their free cash flow, it's almost 90% to 100% of their free cash flow after capex that they are paying out as dividend. But imagine Okomo now keeps holding that money. They keep holding the money. They are not trying to deploy it into something that will give them a return on invested capital that is worthy of that amount they are retaining. So Okomo decide to hold that money, just save it in the bank and be collecting interest rate of probably 15%, which is currently the federal government saving rates. That will be painful, especially when you as a owner of the share think you can redeploy that asset in maybe undervalued assets, and you think you can actually do better than the managers of the business. I don't see any reason why you should stick with Okom. But for me, I see Okom as okay. They give me good return on my reinvested capital, which is probably 10% of their free cash flow. Then they pay out the remaining 80% to me as dividend. Then I can decide to rebuy the shares of Okom, or I can also decide to buy maybe Presco. Presco doesn't pay much dividend, but most of their retained earning is reinvested in the business. For example, they just bought over another mill and a farm, and recently they are still trying to raise 250 billion to also buy another plantation, or I don't know what exactly they want to buy. It's rumor. So if you look at Presco now, Presco might probably be a compounder, because the return on invested capital is higher than inflation, and they are getting to redeploy it in a way that it has been increasing the earning of the business. So if you want dividend, maybe because you are an older person and you want the money from, you don't want the managers to redeploy your capital on your behalf, you can buy Okom. But if you think you want them to redeploy the capital and you are sure of what the managers are doing, you can buy Presco.